So it's Tuesday, February 17, 2026. And if you've been watching the tickers this morning, you might be scratching your head a little bit. Medtronic ticker MDT just dropped its Q3 earnings. And on the surface, it's a beat. They beat on revenue, they beat on earnings per share, they even raised their guidance.
Yeah, and usually that's the recipe for a green arrow day. But if you look at the stock right now, it's down almost 3%.
Which is really the mystery we're here to solve today. You have a company posting its best cardiovascular growth in over a decade.
A decade.
It's finally launching its major surgical robot in the U.S.
Mhm.
and seeing consumer demand for its products just skyrocket. Yet Wall Street gives it the cold shoulder. Why?
Well, it's a classic case of good news but expensive news. We're going to unpack why this quarter is such a massive pivot for Medtronic. They're moving from being, a steady medical supply company to a high-tech growth engine.
Right.
But, and this is the key to why the stock dropped, that transition is messy, it's expensive, and it's squeezing their margins in ways the market wasn't quite ready for.
So the mission today is to look past those headline numbers and figure out if this dip is a warning sign or maybe a buying opportunity. We're pulling all this from the Q3 2026 earnings call transcript, the press release, and of course the financial slide deck they put out this morning.
And we really have to start with the growth engine because, frankly, the numbers coming out of their heart business they're staggering.
The Cardiovascular Portfolio.
Exactly. It grew 11% year over year. And if you just look at the U.S. market, it's up 13%. To put that into perspective, for a company Medtronic size, I mean, we're talking a massive company.
Please.
Double-digit growth in their mature core business is incredibly rare. We haven't seen organic growth like this in 10 years if you exclude the weirdness of the COVID rebound comps.
And the driver isn't just, more people need heart surgery. It's a technology shift, specifically something they call CA-up Cardiac Ablation Solutions. That one segment grew by 80%.
80%. I mean, that is the kind of number you expect from a Silicon Valley startup, not a legacy medtech giant. And the catalyst is PFA, pulsed field ablation.
We've touched on PFA before, but let's just reestablish the baseline here. For a long time, if you had an arrhythmia like atrial fibrillation, the solution was to stick a catheter in the heart and either burn the tissue with heat or freeze it with cold.
Exactly. Radiofrequency or cryo. The problem with those methods is that they are thermal. They rely on temperature extremes to kill the cells, causing the irregular heartbeat. But temperature, it spreads.
It's not precise.
Not at all. If you aren't incredibly careful, you risk damaging the esophagus, the phrenic nerve, other critical structures that are sitting right next to the heart wall.
So PFA changes the physics entirely.
It does. Instead of temperature, it uses these high voltage, ultra short electrical pulses. It's called irreversible electroporation. Think of it like punching microscopic holes in the cell membranes. The fascinating part is that heart muscle cells have a different threshold for this than, say, nerve cells.
Ah, so you could dial it in.
You can dial it in to kill the bad heart tissue while leaving the nerves and everything else completely untouched.
Tissue selective.
Safer, faster, and now clearly the market standard. PFA now accounts for 80% of Medtronic's ablation revenue. It has it's cannibalized the old thermal methods in record time.
Now, Medtronic isn't the only one playing in this space. You've got Boston Scientific, Johnson & Johnson.
Yeah.
Everyone's rushing into PFA. But on the call, management made a very specific argument for why they think they're winning.
They did.
They said competitors are focused on the mapping, while Medtronic is focused on the catheter.
And that's a really distinct strategic choice. So in these surgeries, mapping is the 3D visualization system. It lets the doctor see where they are inside the heart. Competitors are trying to lock hospitals into their proprietary mapping systems.
Right.
But Medtronic CEO, Jeff Martha, is basically arguing that the catheter, the actual tool delivering the energy, that's what matters most to the outcome.
And they have the Sphere 9 and the Sphere 360.
Right. Sphere 9 is their workhorse. And competitors tried to pigeonhole it. They were saying, oh, that's just a niche tool for really complex cases. But the data from this quarter just proves that wrong. It's being used for everything. Persistent AFib, paroxysmal AFib, redos. It's really becoming the Swiss Army knife of ablation.
And Sphere 360 is the single-shot version.
Yeah, single shot means it's designed to treat the pulmonary vein in one go rather than point by point. It just got the CE mark in Europe, and it started U.S. trials. Honestly, the tone on the call suggests they expect Sphere 360 to be even bigger than Sphere 9 just because of the speed.
Wow.
The whole electrophysiology market grew 20% worldwide this quarter. Medtronic is just riding a massive wave.
But And this is where we start to see the first crack in the stock price. Success can be expensive.
That's the mixed headwind we need to flag. To sell the disposable catheters, that's the high margin part, you first have to place the capital equipment, the consoles.
The razor.
Exactly. And Medtronic is placing these consoles at a record rate. That drives revenue up, but because the hardware has lower margins than the disposables, it drags the overall profit percentage down, at least in the short term.
The classic razor and blade model. They're selling a ton of razors right now, which is expensive, and they're waiting for the blade sales to catch up.
Precisely.
Okay, so let's move from the heart to the nerves. The second big driver they talked about was hypertension. And this part of the call, it felt less like a medical device update and more like a consumer tech launch.
The Symplicity Spyral.
Yeah.
This is their renal denervation system.
For anyone who doesn't know, this is a procedure to treat high blood pressure by calming the nerves in the kidneys. But what struck me wasn't the clinical data, it was the marketing. They launched a direct-to-consumer campaign called Go Beyond.
Which is a huge shift in strategy. Usually medtech sells to doctors, here is a better tool, doctor.
Right.
But Medtronic is going straight to the patient.
And the numbers are just wild.
Yeah.
In Q2, their website for this procedure had about 50,000 visits. In Q3, they turned on the TV ads, the digital marketing. Visits jumped to 2.5 million.
A 50-fold increase.
That is 2.5 million people actively researching a surgical intervention for their blood pressure.
It just speaks to the frustration with the current standard of care, doesn't it? We treat hypertension with pills, but pill fatigue is real. People forget they hate the side effects or the pills just stop working over time.
Yeah.
Medtronic is tapping into this massive reservoir of patients who want a one-and-done or at least a one-and-better solution that doesn't involve a daily pharmacy visit.
So are the doctors buying in? Because you can have 2.5 million people wanting it, but if the cardiologist says no, well, it doesn't happen.
The bottleneck is definitely opening up. They opened 200 new accounts, so hospitals or clinics in the quarter, and importantly, reimbursement is there. They now have coverage for 100 million lives in the U.S. That's a third of the population.
It feels like a tipping point.
It is, and it sort of mirrors what we're seeing in their third growth driver, incontinence.
The Ultraviva device.
Right. This treats urge urinary incontinence. It affects 16 million people in the U.S. It's this huge quality of life issue that people are often, embarrassed to even talk about. The Ultraviva is a tibial neurostimulator. It's a tiny implant near the ankle.
The wow factor here, at least according to the call, is the battery life.
15 years. That is just leaps and bounds ahead of the competition. If you're a patient, especially an older patient, the idea of needing a battery replacement surgery every 3 to 5 years is a major, major deterrent.
Oh, absolutely.
15 years basically means install it and forget it.
They mentioned physicians are traveling on weekends to get trained on this.
There's always a key indicator of demand. When you have doctors giving up their Saturdays to fly to a training center because their patients are asking for a device, you know you have a hit product. They've trained 500 physicians just recently.
Okay, so we've got heart, hypertension, incontinence. Let's talk about the fourth pillar, which has been the white whale for Medtronic for a very long time, surgical robotics.
The Hugo system.
Finally, we can say it's here.
Yep.
It received FDA clearance for urologic procedures.
It has been such a long, winding road to get here. But yes, the first commercial cases in the U.S. were performed at the Cleveland Clinic in early February.
Starting at the Cleveland Clinic that's quite a flex.
It sends a signal. But the interesting thing about Hugo isn't just that it's a robot. It's how it fits into the data ecosystem. Medtronic is pushing this touch surgery platform.
That's the AI video analytics thing, right?
Yes. Every surgery Hugo performs can be recorded, uploaded to the cloud, and then analyzed by AI to help the surgeon improve. They said installations of touch surgery systems are up 20% sequentially. They're trying to digitize the entire operating room.
And that ties into spine surgery too, doesn't it? With the Stealth AKS.
This is so critical. Medtronic dominates spine surgery navigation. Think of it as GPS for your back. 70% of U.S. cases use their tech. But historically, switching to a robot meant ditching that familiar GPS and learning a whole new system.
Which surgeons hate.
Surgeons are creatures of habit. Disruption is dangerous. Stealth XIS combines the robot into the navigation workflow they already know and use. It lowers the barrier to entry. It basically says, hey, keep doing what you're doing, just use this better tool to do it.
So if we just pause here, the story sounds perfect. I mean, record heart growth, massive consumer interest in hypertension, best-in-class battery for incontinence, robots finally in U.S. hospitals.
Mhm.
Revenue beat expectations at $9.02 billion. EPS beat at 1.36.
Everything looks green.
So why is the stock down? We hinted at it with the razor and blade thing, but let's get into the weeds.
Yeah.
What actually spooked investors?
It really comes down to the bottom line. It's margins and taxes. Let's start with the tax bill. Medtronic is a global company. They're domiciled in Ireland for tax reasons, but they operate everywhere. The adjusted tax rate for the quarter came in at 17.3%.
Which was higher than they predicted.
A full percentage point higher. And that doesn't sound like much, but on billions of dollars of income, it wipes out a big chunk of earnings. It happened because of the geographic mix of profits. Basically, they made more money in high-tax countries than they'd planned.
And then there's the political angle, tariffs.
This is becoming a really serious headwind. Tariffs cost them $93 million in Q3 alone. But the guidance was the real kicker. They expect tariffs to hit them for $185 million for the full 2026 fiscal year. And for 2027, they're projecting a $300 million hit.
Wow. That is a massive amount of pure profit just evaporating.
It is, and investors hate uncertainty. With trade policies in flux, that number could go even higher. But let's go back to that mixed headwind we touched on earlier, because this is the real structural issue.
So cost of success.
Exactly. The businesses that are growing the fastest, cardiac ablation and diabetes, currently have lower profit margins than the corporate average. In cardiac, it's because they're selling all that heavy capital equipment we talked about.
Right.
In diabetes, it's because they're ramping up manufacturing for the new Symplicity sensors, and new manufacturing lines are always inefficient at first.
So mathematically, the more they sell their hot new products, the worse their overall profit margin percentage looks in the short term.
Correct. It's a temporary problem. Eventually, the manufacturing stabilizes, the disposable sales kick in. But Wall Street operates on 90-day cycles. They see margins compressing now, and they sell the stock.
Speaking of diabetes, they gave a firm update on the spin-off. We've known they wanted to separate the business, but now we actually have a plan.
Two-step IPO and split, and they're targeting completion by the end of calendar year 2026.
So explain the strategy here. Why get rid of a business that grew 15% this quarter?
It's about focus and volatility. Diabetes is a consumer-facing, highly competitive, fast-moving market. It requires a really different management style than, say, selling pacemakers to hospitals.
Sure.
By spinning it off, Medtronic removes that volatility from its books. And crucially, since diabetes has historically had lower margins than the rest of the group, spinning it off instantly improves Medtronic's overall margin profile.
So it's addition by subtraction.
Exactly. It leaves Medtronic as a pure play on hospital-based procedural tech.
But they aren't just subtracting, though. They're buying. There was some chatter about M&A.
They're being aggressive. They mentioned investing in a company called Tariffs. This is for TAVR transcatheter aortic valve replacement. Medtronic is already big in self-expanding valves, but Antares gives them a real shot at the balloon expandable market.
Which extends their addressable market.
Significantly. And they also pointed out that the PFA boom we were just talking about, that came from acquiring a company called Affera. So they are proving they can buy technology and scale it successfully.
Okay, so let's look forward. Fiscal 2027. They gave an early look at guidance. High single-digit EPS growth.
Which is solid, but there was a detail in there that I think confused some people. The extra week.
Right. Fiscal 2027 is a 53-week year. Why does that happen?
It's just a quirk of corporate accounting. Most companies operate on a 4-4-5 calendar to keep the quarters consistent, but 52 weeks times 7 days is only 364 days. So you lose a day or two every year. Eventually, you have to add a leap week to realign the fiscal year with the calendar.
And 2027 is that year for Medtronic.
It is.
So they get an extra week of sales for free, basically.
Pretty much. It adds about 2 percentage points to their revenue growth optically, but management was really careful to say, look, even if you strip out that extra week, our organic growth is accelerating. They don't want investors to think the growth is just some calendar trick.
And the acceleration really relies on the pipeline.
It does. They need neurovascular to bounce back. That business had a rough year with some procurement cuts in China and a recall, but they have new stents like NeuroGuard coming online. If neuro can join the party with heart and diabetes, the growth story gets very robust.
So bringing it all back to that stock price drop today, the narrative seems to be the engine is fixed, the car is speeding up, but we're burning a whole lot of gas to do it.
That's a great analogy. The old Medtronic was a slow-growth, high-dividend, safe stock. The new Medtronic is investing heavily in robotics, in AI, in direct-to-consumer markets. That costs money.
Hmm.
The taxes and tariffs are headwinds they can't really control, but the margin compression from new products, that's a strategic choice. They are choosing to take the hit now to build the installed base for the next
It
decade,
just requires patience.
which the market lacked today. But
Yeah.
if you believe in the tech, if you believe PFA is going to take over the heart market and robots are going to take over surgery, then this dip is just the cost of that transition.
You know, through this whole deep dive, the one thing I can't stop thinking about is that 2.5 million number. The website visits for blood pressure.
It really is the standout statistic, isn't it?
We are absolutely entering an era where a medical device company isn't just selling to a procurement officer in a hospital. They are marketing directly to me on my phone, trying to convince me I need a procedure.
It raises a pretty provocative question about the future of medicine. I mean, traditionally, the doctor is the gatekeeper. They tell you what you need. But if 2.5 million people walk into clinics saying, hey, I saw the ad for the Symplicity procedure and that's what I want, the whole power dynamic
We've
shifts.
seen it with drugs, right?
Yeah.
Ask your doctor about Ozempic. Now we're seeing ask your doctor about renal denervation.
Exactly. The consumerization of invasive medical procedures. It changes Medtronic from a manufacturing company into a brand company. And if they can pull that off, if they can make patients loyal to the brand of their pacemaker or their neurostimulator, that is a moat no competitor can easily cross.
That is a wild thought to leave us with. The next time you're at the doctor,
Wow.
maybe ask yourself, who decided on the treatment? Your physician or a really well-targeted digital ad campaign?
It's definitely the trend to watch as these big four products continue to roll out over the next year.
Absolutely. Well, that wraps up our deep dive into Medtronic's Q3 2026 earnings. A fascinating clash between record-breaking technology and the harsh reality of corporate finance. Thanks for listening, and we'll catch you on the next one.